Hello, everybody. Good evening, noon. My name's Carl Vandermerwe. I'm the sales director at EB-5 Coast to Coast, and we're trying something a little unique this evening. We're showcasing several projects that we're, I would say, involved with, either as the NCE manager on the project or as the sponsoring regional center. So we're showcasing 4 rural projects this evening, and I'll be presenting 2 of those, and then our co-presenters will be presenting the projects that they're sponsoring. So, hi, Zach. Thanks for joining. And Remy, Pastorelli, you'll meet later as well, both be presenting projects as well. So with that, I'll just kick off and introduce EB-5 Coast to Coast briefly, and then discuss the first 2 projects. So just a little bit about us ourselves. We're a regional center, essentially. In fact, we have a portfolio of regional centers that covers the country. We've been in the industry for 14 years. We have, we have national regional center coverage, and we're probably the most active sponsor of projects in the market. So as you can see over there, we're sponsoring over 80 projects currently. And this gives us a pretty unique insight into the market, because as the sponsoring regional center, those projects need to report pretty much everything to us in terms of, investors, their agent relationships, their marketing materials, their offering docs, etc. And so we get great visibility into the market, and it's given us the ability to ideally identify some of the best projects out there to partner with. And that's frankly exactly how we're ended up working with Fidium Broadband and New York Medical Center projects that we're going to be presenting tonight. So yeah, we also we're the manager on several other projects as well, and I'll be presenting two of those tonight as well. So I think that's a little bit about us. If we may, just jump into the first project called All Points North, which is a little unique in the EB-5 space. Because it is an existing company that's operational. It's been around since 2019, and it operates in behavioral health. We're actually, Remy is going to be presenting a project operating in behavioral health as well, although, slightly different market segment. This particular company operates very much at the high end of the market. So they treat essentially patients with mental health and addiction, but, their clientele would typically be celebrities, CEOs, a lot of professional athletes, etc. So very much that end of the market. And this is their flagship facility. It's based outside Vail, Colorado. It's rural. The project's rural. As you can see, it's approved. And the facility itself has been operating at close to full capacity. And so we're raising funds essentially to expand this facility. I think I've touched on some of these. This is structured as a preferred equity offering. So, I would say that the benefit of preferred equity is that I think, from a project point of view, having equity funding it can be beneficial. It can essentially, delever the project and, sort of reduce the overall project risk. And for investors, it can offer potentially, higher returns. And in this case, we do believe there is some upside potential here. That's because the holding company for All Points North has essentially been funded by private equity, and they've raised more than $100 million of private equity funding. And so the way we've structured the EB-5 here is that if this company is sold, which is clearly what the private equity investors are angling for, if it's sold over the next few years and you still invested as a EB-5 investor, you're eligible to receive an exit payment as well, which could be up to $250,000. So there is that upside that is pretty unique in the EB-5 space. It is essentially from to date about a maximum 4-year term. As you can see, the exit is structured via a put option in June 29, which is 3 years from now, with a 1-year extension option. There's a good amount of job creation here. There's a 50% cushion. And I think the other thing that investors are also very focused on is where it is in terms of the construction cycle. We've started, with, I'd say, horizontal work. The vertical construction is due to start in the fall. permitting has been done, and bank financing is about to be done as well. So very close to starting these sort of full-scale construction. The behavioral health industry, I'm not going to profess to be an expert on it. Remy can probably tell us a lot more about it. But I would say one positive thing is that it's generally considered a fairly defensive industry and recession-proof. And so, some investors are of the mindset that there may be a recession, in the next year or two. And if that's the case, this could be a good alternative investment because, the demand has remained strong through all cycles for behavioral health, and there's limited competition at the top end of the market. There are not too many true competitors to this company. This is just a slide on the capital stack. As you can see, basically the bulk of it is EB-5 in the preferred equity position, 58%, with the balance made up of a bank loan and then equity from the holding company. I think, where we are in terms of the capital raise here, it's also important to point out that we've done the bulk of this raise already. We've got around 70 to 75 of the 90 investors. So we're expecting to close this, by September. And the bank debt has been lined up, and obviously the equity from the holding company, they have been funding that as well. So essentially, the way I look at it is the project is now pretty much fully financed, and about to be, to start horizontal construction. Yeah, so this is, I think, important to chat a little bit about the founder, a guy called Noah Northeimer. He's got a great track record, hence the fact that he's raised more than $100 million of private equity capital for this venture. He founded a company in this space prior to All Points North called Concerted Care Group. He actually had some EB-5 investors in that project as well, 18 investors. And that company was sold, in fact, to private equity at almost a 15 times EBITDA multiple, did very well for his investors, repaid all the EB-5 investors. So he's got a very good track record, both in EB-5 and in terms of behavioral health as well. Yeah, so that's, the whole management team, I would say, is singularly focused on growing this business and exiting within a few years. That's clearly the mandate they've been given from the private equity investors. And so, they're very confident that they will achieve that within the next few years. And if you look at the growth metrics, I mean, this company has been growing very well. Last year's revenue was around 50 million. It's estimated to be closer to 60 million this year. And, it's healthy margins and strong growth trajectory. They're one of the top behavioral health companies based on a benchmark that the industry uses. And, certainly when you get on a call with the management team, they're very proud of that. They definitely point that out to anyone, that they've consistently been one of the top behavioral health companies in the industry. So, yeah, I think with that, I might just turn to the next project, which is a good contrast to the first one. As I mentioned, All Points North is a pref equity structure with some upside potential. Pines of Grass Valley is also rural. It's also approved, but it's structured as a senior loan. So, I guess if you're focused very much on security, this offers more security in that sense. Pines of Grass Valley is a multifamily project in Northern California. It's about an hour's drive or 75 minutes from Lake Tahoe. It's a beautiful town. There's a lot of demand in the town for multifamily housing. There is quite an acute shortage of that. Yeah, so I think, as I said, rural, approved, ideal location, and with very strong rental demand. There's very low vacancy rate in Grass Valley. And so I think from a project feasibility point of view, this project is a very strong project. I think, I think in terms of the rental demand and the likely exit down the road, which will most likely be a refinancing, there's, there's a very strong, the feasibility certainly makes that a very viable option. The way this is funded is essentially EB-5 in the senior position, senior debt, 24 investors here. We're about to launch this project, so we actually don't have any investors yet. We do have a couple of investors lined up. We're in the early stages on this one. The rest of the cap stack is C-PACE funding, which, if you're not familiar with that is essentially funding that you can qualify for if the project meets certain energy efficiency standards. And it is ideal for an EB-5 project because it's fairly low cost. It's pretty long term, typically 25, 30-year funding. And it sort of matches up very well with EB-5 because it doesn't necessarily need to be in the senior position. So we've got senior debt, C-PACE, some mezzanine debt, and some equity from the owner to make up the rest of the capital stack. The loan term here is 3 + 1 + 1 from the start of the first advance, which should be this month. So essentially a 5-year term at the max. As I mentioned, it's secured by the property, essentially, which is appraised at $48 million at completion. So with less than 20 million of EB-5 and 48 million of appraised value, let's say 2 years from now, that's a pretty conservative loan to value ratio. So a lot of collateral there to protect EB-5. But in addition to that, we've also negotiated with the sponsor developer a personal guarantee that in the event of a default, we essentially have the right to go after his own personal assets to ensure a recovery. So there's, I think there's two very solid insurances that investors will get paid back. There's, the first deed of trust on the property, and there's the personal guarantee on top of that. And I would add, that we drafted those guarantees. This was not something that the sponsor drafted. We did that. We feel it's a very watertight agreement, and so I think that makes us feel very comfortable with this offering from a security point of view. The job creation is reasonable, I would say. With maximum 24 investors, we require 240 jobs. There's a 30 job cushion, which is 12%. Yes, ideally you'd like to see a bigger cushion, but the important thing is that almost all of those jobs are construction related. So more than enough jobs will be created as long as the project is completed. And we have a completion guarantee as well to ensure that the project will be completed. So effectively that boils down to a job creation guarantee as well. The exit strategy will be a refinancing down the road. And I think there's a very plausible scenario because of the obviously they'll have rental income. It'll be and once that's stabilized, there are definitely institutions that would gladly refinance this property. Again, if for some other reason that doesn't work out because the refinancing market is not very strong, then we've got the first mortgage position and we've got the personal guarantee if for some other reason they fail to repay. I think as you can see where they are on construction, there is basically they broke ground this month. All the permitting is in place, and so that's another big positive there. That means essentially it means job creation is about to start. So thank you. I maybe I ran through that a little quickly, but obviously happy to answer questions on any of these projects at the end of the presentation. This was just meant to be a sort of a quick introduction to these projects, and happy to dive in more later. With that, I'd love to hand over to Zach. Thank you, Zach, for joining us, and please go ahead.
Yeah, hey guys, great to meet you all. My name is Zach Savage, and I'm one of the co-founders of Broadband Capital Solutions, which broadly just helps internet infrastructure companies raise capital. We're pleased here to partner with EB-5 Coast to Coast to bring a project from Broadband, which was formerly known as Consolidated Communications, or actually to bring its third EB-5 project to market here. So just flipping, we'll touch on all of these, I think, highlights as we go. But just quickly, I'd flag, we think this project is really special. It's from a developer that's already done 2 projects that mirror this project to a T. The project is already under construction. Roughly 40% of the total capital has already been put in the ground. The project is not contingent on EB-5 financing. This company has more than 500 million of liquidity on hand and has already greenlit this project in its entirety. So this will get built, hell or high water. This has a huge job creation cushion, roughly 140% more job creation than we actually need to make sure every one of the investors we're hoping to place in this receive their approval. Investor capital can be deployed immediately upon receipt because we are live and under construction. And then lastly, I think we'll dive into this more as we go, but I do think this is maybe the most creditworthy EB-5 project you'll find kind of in the market today for some reasons I want to come back to. But yeah, just to talk a little bit more about the project and who the sponsor is. Look, Fidium is the largest and kind of market-leading internet service provider in New England. They're investing $122 million to run fiber internet and revamp data center equipment so that they can upgrade the internet speeds they provide to their customers across counties in Vermont, Maine, and New Hampshire. And that sounds like a lot. So I want to quickly double click on what that all means before we get into some of the EB-5 specific pieces of this. So look, all internet traffic ultimately runs over some type of cable or fiber and gets routed to a data center. Doesn't matter if we're on Wi-Fi, if we're on cellular, all of that is ultimately running through some type of cable and into a data center in order to process and exchange information. Historically, that ran over copper wire that was originally laid down for phone access. You might remember that was the era of dial-up internet, and man, that was slow. Over the last couple of decades, a lot of folks have upgraded to running that internet traffic over cable, which is what probably most of us have relied on for internet access over the last 10 to 15 years at this point. But now today, with broad-based internet streaming, the advent of AI and what that means for what we all want to do on the web and just more like digital access, all these internet service companies are realizing they need to go to what's next. And what's next is laying fiber optic cable. That provides the greatest data throughput and the least latency to kind of future-proof the internet speeds that they can provide to their consumers. And I think importantly, fiber literally has no throughput cap. So this will truly be the last generation of internet infrastructure that any of us will ever see in our lifetime, because no matter how much faster our internet speeds need to be or how much more data throughput we need, this fiber that Fidium is laying to its customers in rural New England here will be able to, with some data center equipment upgrades, provide for that. So that's the project. On the actual EB-5 piece of it, and Carl, if you just don't mind going back one slide, we're raising $80 million to help finance this project. The rest will be done with developer equity. This project does classify as rural. As I said before, it has 140% job cushion. I think uniquely based on what has already been spent, I think we already have like 70% of the required job creation for this project. So we are really set from a job creation perspective. And again, I know I said this in the highlights, but this project's going to be completed regardless of the quantum of EB-5 financing we raise. This company has 500 million on hand. The board has already greenlit this project. So there's no contingencies or risks of this being built. So maybe just to flip, there's not a ton to say here other than just to make the point that Fidium has a lot of experience with EB-5. They have done 2 projects that were both hyper successful that mirror this project to a T. They were building the same exact infrastructure in the same exact regions, just in adjacent counties. So this is really a continuation of those former 2 projects that were raised over the last few years and were already successful. And I touched on this a bit, but maybe just to dive a little bit more into who Fidium is. It's one of the largest and oldest internet service provider, internet infrastructure companies in the country. This is a really big business compared to most of what we engage with in the EB-5 space. It has over $1 billion of revenue. It has, 500 million of cash flow and growing. It has over 5 billion of assets at cost in the ground, which the owners of it today appraise at somewhere between $8 and $10 billion. So this is a really scaled asset. Touching into what I said before, it's in this multi-year strategy of systemically upgrading its entire footprint from legacy infrastructure to this next generation of fiber to ensure it can provide its customers with the fastest internet speeds they need. And it's already spent actually $2 billion to do this over the last 5 years. So this incremental $122 million project we're talking about is very bite-sized relative to what this team has already accomplished executionally. Like, they know what they're doing and they know how to build this stuff on time and on budget. Last thing I would just say there is that strategy is really working. It's growing. Like, the investment they're making, like, customers are realizing it. More people are signing up. They're able to take price somewhat. I think the stat is like consumer fiber subscribers have actually 5x'd in the past 5 years, and total company EBITDA is up 60%. So this is really a growth strategy or a growth company underpinned by the investments in fiber that they are making in order to future-proof themselves and provide best-in-class service to their customers. Just onto the project capitalization and budget, I'm actually going to talk about this a little bit differently than it's displayed. I want to just talk about why this project is so creditworthy, because I don't know if it really comes through on this slide. But maybe just to step back and talk in contrast. As you probably all know, most EB-5 projects are secured by real estate that is yet to be built. Often that isn't, for these rural projects, that means that if there's an issue with the development, there is an issue with the creditworthiness of even the most senior notes, because the land itself isn't worth much. This is secured by a multi-billion-dollar operating asset. Our developer here, Fidium, has agreed to not only secure our notes with what is being built, but by the entirety of the existing business. And as a reminder, that business is doing more than roughly 500 million of cash flow and growing today. And so just to drive this home, if for whatever reason the project in question that we are building was destroyed by an act of God, you should all still get your money back, because there are billions of dollars of other assets generating 500 million of cash flow and growing, still backing them. So we're still backing your note and providing you security. And I think the credit markets in this country really recognize this. As you may all know, I think the interest rate on debt that sits at parity with most EB-5 money typically in the open market will trade at a 10 to 15% interest rate. So that's roughly a 500 to 1,000 basis point spread to US Treasuries. The notes that this EB-5 financing sits at parity with in the Fidium cap structure is priced at 7% right now by the pension funds and credit investors in the markets who have bought the rest of this tranche. So that's like roughly a 250 basis point spread to what you can buy US Treasuries at. So just to kind of hammer that home, I think the broader US capital markets have effectively think this is less than half as risky as the debt you're seeing in most probably EB-5 contexts. And then here, Carl's kind of positioning us towards the repayment timeline. Look, a few things I'd call out, because we're already under construction, 40% of the capital for the total project has already been put in the ground. Your capital can be deployed into this immediately. Like, truly within weeks of you wiring us, we can close on this. We have the job creation will be met in 28. Based on where we're tracking now, job creation will likely be met far before that. We've already created, I think, again, 70% of the jobs needed for all investors in this. And yeah, we are going to be repaying in roughly 4.5 years. It's a fixed repayment date as of March of 31. So yeah, thank you all, and look forward to taking any questions you guys have towards the end of this.
Yeah, that was great. Thank you, Zach. I'm Remy Pastorelli. I'm the CEO of Universal Healthcare Partners. We're the NCE manager behind New York Medical Center. Our project, I'm sure you're going to hear this throughout the night, is unique and special, but specifically for the fact that it's addressing a community need. In the surrounding counties in Chautauqua, there is a mental health crisis. As Carl mentioned earlier, we don't necessarily compete with the world-class state of the luxury mental health facilities. What we instead are focusing on is a genuine need in Western New York. There's roughly a 700-bed gap across 9 counties, all the counties being rural and not having access to mental health services for up to 45 miles. So where the project is located happens to be perfectly strategically placed because it's an epicenter where mental health is needed. The project is already approved. It is a rural TEA project. It's already has 526Es approved. It's been we just closed or submitted our I-956F last year in 2025. In April, we had our approval. I believe in October 2025, our first investor got their 526E approved just a couple months ago. Well, actually 4 months ago. We've just started receiving other approvals. So we have priority processing when it comes to this project because it is addressing a crisis. It is a big need in the area, and you'll see if you request documents on this, we have support from the senators, the governors, all the way down to local and state support, because this is a very much needed project to be open. The former hospital group that owned this facility, they just relocated to build a facility about 20 miles down the road. So they didn't take away the services for lack of economics or finances, just simply for the fact that they got state funding. So this project, when the hospital was basically moved away and relocated, over 300 full-time jobs were gone. And so unlike other projects in the market, the JCE here will have a full-time staff of about 300 to 350 people. With the construction of it being a former hospital, New York State requires that it is repurposed into code-specific behavioral mental health, meaning no self-harm, no loose screws, and therefore the construction budget is roughly of around $40 million, 32 being the EB-5 placement, where the operator has 8 to 10 million skin in the game. Uniquely to this project as well is the landlord has provided a landlord guarantee. When we submitted this project, the appraised value of the building was 31.5 million. So just about $500,000 short of the EB-5 placement. However, the future completion of the building is over 50 million. And being that it is senior in the capital stack, it allows investors to be a very, very safe, if you will. The repayment plan is from the operations of the business. It is planned to be the business itself, the JCU will be doing about $750 to $1,000 daily bed reimbursement on a 28-day minimum. So just high level, what that looks like year 4, year 3 for the JCE is roughly about 40 to 45 million in gross revenue. So the business is in a unique position, and being that it has a high revenue forecast, we're allowed to pay interest at least at 2% to investors, at Reg D investors, that is. So the project is addressing a need. It has support. The construction has already started. They're already getting their first units open in August. They got their certificate of need. They just did the walkthrough with the Department of Health and Oasis and CMH. So they're at the point right now to just ramp up. Any EB-5 capital that comes in could be immediately deployed, as construction is for the psychiatric beds could get started right away. They've already submitted their licensure. They already have their permits approved. And seeing that this business and their project will have 300 full-time jobs and then indirect jobs of about 200 to 250, we have a very nice job buffer, almost double the job buffer at the moment. So for investors, it's a rather safer project, but it's a smaller project. It's not a Fidium. It's not a world-class facility. It's a rural healthcare facility in a health desert that desperately needs the jobs. It needs the mental health services. So happy to delve into that further, and if anybody has questions, but I appreciate you guys learning a little bit about New York Medical Center and the team that's been doing this for about 20 years.
Wonderful. Thank you very much, Zach and Remy. I think it's wonderful to see the diversity of EB-5. And, these are all very unique projects, I think very strong projects in our opinion. And I think you've heard why, why we believe that. So I'd maybe just dive into some of the questions here. How many subscribe to APN? As I think I mentioned, we were between 70 and 75 out of the 90 subscribed to date. we're in fact a co-manager with a firm called LCR Capital. When I say roughly 70 to 75, I'm not exactly sure what their current pipeline looks like, but we're very confident that we'll get there by the end of September in terms of fully subscribed investors. Is the project approved or waiting for approval? I'm not sure which project you're referring to, but if it's All Points North, it's approved. If it's
It looks like it's Fidium, Carl.
Fidium, it's awaiting approval, right, Zach? We filed the F 2 or 3 months ago.
Yeah, no, we filed the F actually in April, so we are hoping to get approval any week now, but we have not formally gotten approval. We do have, again, I think we'll have approval any week, but we do have full investor money back guarantees if for whatever reason it is not approved.
Okay. Are there any fail-safe guarantees in APN? Guarantees you're going to be a little careful with in EB-5. There are no specific guarantee. Well, there is. There is actually a corporate guarantee, a $25 million corporate guarantee. But you're also investing, though it's pref equity, you're investing into an entity that is quite valuable and will be very valuable at completion. So we've got appraised value, for example, of the phase 2 that you're essentially investing into of around $130 million at completion, which should be somewhere towards the end of 2028. So even with some senior debt ahead of you, maybe around 40 million, there is plenty of collateral there to underpin the pref equity position. So from that perspective, we feel that the risk is mitigated. It's also, overall the company has got a modest amount of debt, less than 20 million. It's largely been funded by equity. And obviously it's a growing business with strong demand for their services. So that's, that also mitigates the risk. We don't see a lot of operational risk in APN. Next question, what do you think about satellite internet link Starlink taking quite a bit of market share from fiber? Zach, I'm definitely not going to handle that one.
But I guess just to give you the data, fiber is actually gaining market share like quite quickly in the internet service space. What Starlink and satellite is doing is amazing. It is also gaining share, but it's gaining share in areas that don't have access to high-speed internet. So it's gaining share from that legacy copper infrastructure we spoke to. Satellite is never meant to be a wired home solution that would be the mainstay of internet in any area, any developed area that could get fiber. It's structurally slower and structurally more expensive. So maybe I'm doing a bad job of framing this, but both satellite and fiber are the two technologies that are gaining share in internet today. Fiber is only going to be available in areas that are dense enough to convince someone to run the fiber through them. But in any area it is laid down, it will be faster and cheaper than satellite structurally. It's just structurally faster. You literally can't run a satellite connection that fast, and then it's structurally cheaper to service. But satellite will also do very well and take share in areas where the economics of laying down the capex to run fiber to those homes don't make sense.
Yeah, that makes sense. Sorry, let me see. The next question also for you, Zach. You mentioned 70% of the jobs have already been created. How does that impact new EB-5 investors coming in? It
just means that you're not taking any risk whatsoever from a job creation perspective. That's all. It's only upside for you.
Yeah, you can claim those jobs because, as you're saying, Zach, the job's already there. And so that's pretty unique in EB-5 to come into a project that's pretty much created most of the jobs already. Also for you, Zach, by what time do you plan to have all the jobs created?
I want to, my partner Ryan is on the line and maybe a little closer to this. It will depend on the exact cadence of construction. I think we had conservatively put 28 in that slide, but I believe we are on track to do so by, honestly, early 27. But Ryan, please chime in if...
Yeah. So if we think about the project creating 24 jobs per investor, I would say 80% of those jobs will be created either by the end of this year 2026 or the first quarter of 27. The remaining 20% of jobs, so effectively what gets you from say 20 jobs per investor to 24 jobs per investor, will probably come in over the next year after that. So by mid 2028, I would say all jobs are created. But the job creation should be 100% cushion created by the end of this year or early next year.
Okay. And just Ryan, on that, jobs are created one of two ways. That it's through the spend on the project or the projected revenue from the project. And in this case, are those jobs based purely on spending? Is that
Correct?
Yeah.
100% of the jobs is based on spending.
Okay. So that I think
Just
that
to
answers.
clarify,
Yeah.
sorry, just because I want to make sure we don't mince words. When do you think we'll have, forget the cushion, I know we're going to create well more jobs than investors need, but by what like quarter do you suspect the project will create all the jobs the investors need if they just need to hit the minimum job requirement?
Oh, that might be next month.
Yeah, that's what I was thinking.
Okay. I mean, the question here, can you and will you repay the loan before the sustainment period? I mean, that's a question for any project. Nobody's going to do that. You have to complete your sustainment period, but you're bound by whatever project you invest in. You're bound by the offering documents essentially, and what the investment term is in the offering document, and it's going to differ from project to project. So, I mean, I guess this was a question for Fidium. Fidium has a defined exit date as well. And so, that's roughly 5 years from now. Is that right, Zach?
Yeah, it's a fixed date of March of 31. So
Yeah.
practically think of it as a 4.5-year note.
Yeah. So, any investor that comes in the next, within the next year, your sustainment period will comfortably be over because your funds are going to be deployed right away. And so, that's not really an issue. I guess question, All Points North question: how is preferred equity different to senior loan for Pines of Grass Valley? Can you give us a bit more developer background? Yeah, certainly. I think if maybe the easiest is if you wouldn't mind just dropping me an email. I'll send you a sort of brochure with the developer's background. So I'll be happy to share that, or answer any other questions you have. How does preferred equity differ from a senior loan? Well, obviously a senior loan has collateral and preferred equity does not. So that's the most important difference. But preferred equity does offer some potential upside benefit that you wouldn't really get with a loan. A question again for you, Zach, I guess. The denial refund, as far as the denial refund, okay, it's kind of a technical question. I wonder if we should just try and address this offline, maybe just regarding.
Well, why don't you give it a try and we can address that.
Okay. So the denial refund, the documents state that the denial happens. No replacement or refund occurs if the denial happens after project construction is substantially complete and the minimum job requirement has been satisfied. When will construction likely be substantially complete, and when will the minimum job requirement likely be satisfied? So I think Zach just mentioned that could be the latter could be as soon as next month. But when will construction likely be substantially complete? I mean, that's a little vague, right?
Yeah. Again, Ryan is going to he's a little brighter than I am and a little closer to the details. So I do want to let him chime in. Again, when we'll have minimum job requirement is quite a bit different than when construction will be substantially complete, because we have such a huge job buffer. We will not have, I don't believe we will have, quote, construction substantially complete until after, Ryan, please jump in, but I guess construction will slow over the winter due to the weather, and then it will pick back up probably spring of 27. And my guess, based off the capital deployment we're tracking right now, it would be spring, summer of 27 is probably when that horizon would hit.
Yeah, we don't anticipate construction completion, substantially completion to to occur until 28. So, we think that there is, significant time for everyone to make their filings, have their USCIS review, and denials would likely happen before that.
Okay, another question for you, Ryan. Phase 1 for Fidium, is it completed? Has the capital been repaid, or
Phase 1 is complete, which the timing of that aligns with sort of what I just said. And the capital has not been returned. Phase 1 was a loan that was issued in 2024. It was a 5+1+1 loan. So the phase 1 loan, actually, I have to check exactly the dates, but it is possible that loan will ultimately mature after this one.
Okay, interesting. Okay. Another question on Grass Valley. When can one subscribe to Grass Valley project? Most likely next week. This was one of those projects that we were initially the sponsoring regional center on, and then we felt it. We really liked the project, and we basically got involved as the NCE manager. The initial manager on the project was fairly new to EB-5, and I think probably underestimated a little bit what was involved in raising EB-5 capital. And so we stepped in as the NCE manager, and basically we had to file an amendment to that effect, stating that we're now the manager on the project, which we've done or are in the process of doing. And so I think we'll be able to subscribe investors by, I was told, by Friday or Monday or Tuesday, early next week. So I think we're very close. We have a number of investors that are interested in the project and essentially waiting for the documents, the offering documents. So we'll be able to share that with anyone that's interested, certainly by next week. For Fidium, are the jobs accounted direct or also indirect ones? I think we answered that. They're all essentially based on construction spend, and so that is the best. Those are the best kind of jobs because they're not revenue-based jobs. They're created earlier and upfront, and job creation is really it's a very strong point, selling point here for Fidium. This is an amazingly job-rich project, and so
Look, guys, just to directly answer, they're a combination of direct and indirect. If you are in the weeds of the legislation, you know that there is only a certain ratio of indirect jobs that can be claimed, and the numbers we're quoting you track that ratio. So there are fully allowable jobs that are counted by the USCIS based off the money spent, and so the job numbers we are quoting you will they'll definitively be accepted by the USCIS. They're not contingent on everything. They will categorize, or they will count towards the quota you need to receive your visa.
Okay. Sorry, I'm just jumping around here because it's so Fidium again. Will a default trigger cross default on other bonds, notes, debt?
Ryan, cut me off if I'm wrong, but yes, there would be an event of default that would tip the entire company into default. The way this note is structured is it's structured in an asset-backed security trust. Happy to get into the weeds of that, but the overarching point is that this is a specific structure that gives creditors, including our EB-5 note, much more protection than the typical bankruptcy process. It pretty much immediately turns the entirety of this asset base over to the creditors, so that the equity holders immediately forfeit everything. They can't sue in bankruptcy court. They can't drag their feet. They can't try to extract money. Just immediately an event of default, and they get totally wiped, and all assets get defaulted to the creditors with no legal process. So again, yes, but any event of default across any of the notes would tip the entire thing into default, and all the assets would immediately move to the creditors.
Yeah, thanks, Zach. Thanks, Remy. You've been patiently waiting. I'm sure I'll get to you.
I've answered my questions directly with the asked. So if anyone has,
I'm loving all these questions. It's great because I don't know what's going to pop up next. But So how many jobs in APN has been created, and when can we expect the money back? We are due to do a job update for the 956G filing at the end of September. All projects, in fact, have to do that, so we will do that. Yeah, money back. I mean, there's a put option effectively in June 2029 that we will exercise on behalf of all the investors wanting to exit. APN can defer for up to 1 year, so June 2030 is the latest exit date, so which is effectively 4 years. A general question: what's the risk of retrogression in rural projects? I don't think we sort of want to get into that. There are plenty of experts on that.
Yeah, we're not lawyers, but I would say, invest before the deadline, right, Carl?
Yeah, absolutely. I mean, one plug for All Points North is it actually qualifies under both rural and high unemployment. So if you don't want to speculate on which category is going to retrogress first, invest in a project that qualifies under both, and then you've got that optionality. So that is, that is definitely, I believe, could be quite a valuable benefit down the road. What if APN doesn't get all the investors? I'm not concerned about that anymore. I think, we 70 to 75, we need maybe 15 or so investors, and with the activity levels in the market right now, we'll get there certainly by the end of September. I think I spoke to our co-manager LCR Capital today. They're confident they're going to bring in all the investors, so even if we don't bring in any more.
Carl, we have a few questions for Remy at the end. If you
Yeah,
want
please go ahead.
to-
How does the personal guarantee repayment and exit work for Grass Valley? I think maybe that I can send an email with the with the guarantee and share that with anyone that's interested. The repayment is through a refinancing down the road. Let me see. Okay, I think with Fidium, what is the exit strategy? Did we discuss that, Zach or Ryan?
Oh, sorry. Say that one more time.
The exit strategy for Fidium, if you wouldn't mind just touching on that again.
Yeah, sure. So an exit in the Fidium deal is really going to come through one of three mechanisms, or let's say one of four mechanisms. The first is an ordinary course refinancing. Fidium, Zach mentioned the scale of Fidium. I mean, Fidium is a seasoned issuer in the debt markets. Just by way of example, their last bond offering was a $665 million offering in March of 26. Come maturity, this is a fairly small, fairly small bond for them to refinance. So, I don't anticipate them having any issues with that. The second way is they have a fairly large revolving credit facility. So they have a $500 million facility, of which, the vast majority is undrawn. And so if for whatever reason a refinancing is not the desired path, they could easily draw down on that revolving credit facility to repay these notes. The third would be just using, their internal cash flow to pay the note back at maturity. As we've said, this is a business that generates $500 million of EBITDA a year and is growing. So it is generating meaningful cash, and we'll have enough cash to pay it down. And then the last one, which is entirely possible, is that the sponsors choose to sell the business, and using the proceeds of that sale, they'll pay down all the debt of the company. So we think that there's many roads to Rome here, all of which provide a lot of comfort as to the ability to repay this at exit.
Thank you. Right, Remy, for you, you want to just talk a little bit more about the cap stack, because a big chunk of that is EB-5 and the exit strategy.
Yeah, no problem. I think in order to understand why a majority of the cap stack here is EB-5 is to understand kind of how healthcare works. Most healthcare operators in a rural market could enter the market being a nonprofit, not use EB-5. Because this is redeveloping a 171,000 square foot facility, and roughly that cost to do that is somewhere between 100 and 220 a square foot. there's a tremendous opportunity for EB-5 to be placed, with job security being very, very pivotal. So for that reason, that's why EB-5 is in there for the construction cost. Simultaneously, because it's a large facility, and each behavioral mental health bed, there's 162 beds, but each bed has to have about two full-time staff, three full-time staff. You have nurses that do 8-hour shifts. So you'll have three full-time staff members, or at least two full-time staff members and one part-time staff member, depending on USCIS counts that job, right? When they're fully open. So that's a tremendous job buffer. So for EB-5 to be placed there, it works for it being a for-profit entity. The JC here has already deployed their own equity to get this close and this far and along in the project. Construction has already started, and in order for them to get their certificate of need, they have to show about 6 to 8 months of payroll on hand in their own cash, not EB-5 money. That's roughly about 1.8 to 2 million just sitting around in an account, ready to be deployed for cash, for payroll, for staffing and operations. So that's a big reason why EB-5 is a big chunk. And to kind of pivot to that, or caveat to that, if you will, EB-5 being a big chunk, how do we defend it for investors? How do we make sure we have some sort of collateral? The landlord is not the JCE. It's a separate entity. The landlord's disposition is, as the JCE is developing money into this land, the building's going to be worth more money. Being that it's going to be worth more money, he could refinance, and at any point the JCE decides, God forbid, to default, not pay back money, you have an extra level of protection, a UCC prepared to be filed on demand, with the landlord guarantee internally signed. So we have that as collateral internally, right? Of course, we can't make the investment guaranteed. EB-5 is not a guaranteed investment, so we have to play around with how can we protect investors. Another way that we do that is having the JC complete a completion guarantee and a denial guarantee. So based off the revenue of the business, as I discussed earlier, mental health, and Carl could allude to this in the slide he showed earlier, is a very profitable recession-proof industry. This has been proven over the last 30, 40 years. And if you look at America's GDP and leading sectors, 50 years ago was manufacturing. In the last 20 years, it's been healthcare. And rural healthcare specifically is getting extra attention as the big beautiful bill that was passed. Yes, it cut down Medicaid costs and spendings for a lot of local operators, but it opened the pathway for a lot of incentivizations, for grants, and all types of money that operators that are for-profit and non-profit in the healthcare space could get. When NYMC is fully open, they're already eligible, and this is already shown in the PPM with the letters of support. They're eligible for about 22 million in grants from New York State and construction grants and Governor Hochul and a bunch of different things that they're eligible for. Of course, in order to be eligible for that, you got to show 6 months of being open and doing the patient services and have the CON number there. I hope that kind of explains how EB-5 is put into the stack and why it's so important that we're using it in this stack as opposed to building a hotel here in New York or in Miami. The goal here is to take advantage of the heavy construction costs, the full-time jobs that are projected, and the implant that was done by Baker Tilly to deploy the loan, the EB-5 loan, immediately into doing the construction that's associated with getting open. And they're getting open in phases. First 25 beds in the month of August, the other 25 beds before the end of the year, and then the larger construction, which will be starting, or it will continuously starting from December all the way into 2027, 2028.
Thanks, Remy. And what is the likely exit scenario for EB-5?
Great question. There's multiple exit scenarios. I think the number one exit scenario is from the operations of the business. Being that the capital needs to be sustained for 2 years is actually perfect, because by year 2, the JCE will be able to start paying a minimum of $50,000 of principal towards each investor based off the revenue. That's already been put in the business plan. That was approved by USCIS. This is, again, not inclusive of grants. So grants could be used to repay debt, principal specifically. So there is some unique strategies there that we've discussed with the JC to say, hey, if you guys get 15, 20 million, would it make sense if we're in year 2 or year 3 to start giving some of that capital right back to investors? Which the answer is yeah, absolutely, right? So there are strategies associated with them getting grant money and private equity funding additionally to their stack, but primarily them just getting open. even getting 100 beds out of the 162 beds open, they'll be doing about $2.5 million a month in gross revenue. So as you guys can imagine, at an EBITDA projection of about 15 to 25%, they're able to repay investors comfortably in 4 and 5 years. In the instance they don't, we do have the 2 one-year extensions. And that's why we have the repayment addendum put in place to say, hey, starting year 2 and onward, 50,000 of the principal is going back to investors that have been sustained in 2 years. So that's the business plan for them, and that's their main exit strategy. And God forbid they default, the landlord having a building that's worth 32 million could either one, find another behavioral mental health group to take it over and replace the CON and licensure, or sell it, right? Sell the building and walk out with a project and break even, which is still better than losing money, folks, right? So just a strategy on that as a phase or a plan C, God forbid, if you will.
Excellent. Another question for you, Remy. How many, where are you in terms of the capital raise? How many slots left?
Yeah, limited slots, to be very transparent with you folks, because this has been interfiled for expedite, has priority processing, and is addressing a health crisis and hits all the boxes for a very fast application for a 526E. We've submitted, we've got the approval less than a year ago, and we already are at a third subscribed. We already are seeing in our pipeline somewhere between 20 and 25 investors ready to invest, both Reg D and Reg S. This is a bilateral offering where we have the option to also solicit overseas. So we have a lot of traction on this, enough so that we've had discussions with the same developer to develop ancillary services to NYMC. So we have limited slots. I would say less than 15 available at the moment.
Thank you. Okay, I think maybe the last question here, just to keep it on an hour. Ryan, maybe if you could explain a bit about the Class C notes and the spread with bonds. I think I'm not quite clear on the question here, but I think you touched on this earlier. Just if you wouldn't mind just talking a little bit about this, the relative spread of Class C notes and the implications. Yeah.
So from a Class C perspective, maybe let's talk about, we have 3 classes, A, B, and C, that consolidated FIDIM issues. The Class A's in the latest deal priced at 5%. So, if you think about SOFR right now being, roughly 4%, that's effectively SOFR plus 100. So that's about as tight as something could possibly price. The B notes trade or priced just slightly wide of that, maybe 50 basis points wide of that, around 5.5%. And when they issued C notes in March, because as part of that $665 million raise, they issued over $80 million of Class C notes. Those were at a flat 7%. So, roughly SOFR plus 300. So, I would say all of those were incredibly tight. We're really talking about, this is not a high yield, right? These are not really super high yielding notes, which I think is indicative of the fact that they're relatively low risk. But that is the relative spreads of the A's, the B's, and the C's. So the C's offer, about 300 basis points of spread. The A's were 100 basis points, and the B's roughly 150 basis points of spread relative to, SOFR as a benchmark.
So thank you, Ryan. Well, I think we've addressed pretty much all of the questions. If I missed some, I apologize. Please just drop us an email, and we'll get them answered. But thank you, Remy and Ryan and Zach and V and Q. Thank you very much for attending as well. I think we had a pretty good attendance, and we had some very good questions. So I hope it was helpful, and thank you very much. Have a good rest of your evening.
Likewise. Thank you, guys. Take care.